Let's talk more about whether the year-end rally is intact. Barry Bannister, Stifel chief equity strategist, joins us now. Barry, why do you think, let's just start with your overall take, why do you think the market was so surprised by yesterday's events?
Well, I think that what's interesting about Treasuries is they're starting to provide good competition for risky assets. You know, the Fed funds should be at about 4%. It's the right real rate to maintain. Inflation is sticky. The yield curve should be positively sloped, plus 1% or so, and the 10-year should be closer to 5%, if not over. And so it's putting a lot of pressure on risky assets where valuations just got very stretched.
Your view is that GDP decelerates in the second half of next year with that sticky inflation you mentioned, and you think that contributes to a correction of 10 to 15% over next year. Why is that? What's the base case for that hypothesis?
The Fed is walking down a ledge that's getting progressively narrower, and there's really no lasting inflation progress without a cooling of labor. We know that labor is the ultimate late cycle play, and we'll see slower wage growth into 2025. If inflation is sticky and wages are slowing, then what happens is real wages after inflation, are actually getting less. And so consumers, having gorged themselves, are going to pull back, and that would contribute, along with housing, non-residential construction, net exports in lagged effect of the dollar, and government disarray. We're not going to get a lot of fiscal at the margin. So overall, GDP would be essentially cut in half on a year-over-year basis, from being up 3 to being up about 1.5. And that's a mid-cycle slowdown. We had one in 2015. We had one in 2012. We had one in the several times in the O's. It's a normal thing, but it does cause a correction.
So, Barry, how are you building in, if at all, whatever probabilities for policy moves along the way that could move the needle or not on GDP and earnings growth and such?
Well, we had said that the Fed would pause. That was our call for the 25 outlook, and that they would stop at 4.0. And now the pricing is about 4.0 in 2025 on short-term rates. And like I said, if the yield curve is positive, and if we didn't have such a repressed term premium in the 10-year, we'd be looking at 5. So it is competition for risky assets. Remember, I mean, I don't use the Fed rule, but every 100 basis points on the 10-year is giving you right now 1,000 points on the S&P, because 1 divided by the yield is a proxy for the multiple. So you're in a world where you've got the very best of both worlds, good economic growth. The Fed is pausing, but long-term yields are low, and that keeps your multiples high.
Yep. Thank you so much for breaking it all down for us, Barry. Really appreciate it.